Thank you for joining us this morning. We're here at the International Monetary Fund, and we're going to discuss one of the analytical chapters in the Global Financial Stability Report. This chapter is titled Banks' Dollar Funding, a Source of Financial Vulnerability. I'm Josh Schumbrun. I'm an economics reporter with the Wall Street Journal, and I'm joined this morning by Adolfo Barajas, who's the lead author of the chapter. So Adolfo, to start off, why don't you tell us about why you decided to look into this as a source of vulnerability in the financial system?
Okay. The way we think about this is we have to go back to the global financial crisis. Now, we call it a global financial crisis, but we all know that it originated in a specific market in the U.S. So how is it that a U.S. mortgage market crisis became global? And one of the channels that we witnessed was banks outside the U.S., banks headquartered outside the U.S., had been growing their dollar activities, and in a very large scale, running up to the crisis. So they required U.S. dollar funding. And when the funding for these banks became impaired because of U.S. specific problems, there were reverberations. There were shock waves that spread beyond the United States and into banks and institutions that had no exposure to the U.S. mortgage market. So last year, April 2018, colleagues of ours in our department in the Global Financial Stability Report took stock of this issue and said, well, where are we roughly 10 years after the crisis?
And where are we now? I mean, what do we find? Does it look like we might be in for some sort of repeat?
So what they found, they indicated some vulnerability or fragility indicators, and they tracked these, and they said that the problem has not gone away. It isn't necessarily worse than it was during the crisis, but it certainly hasn't abated. So there are signs of concern that you need to track these issues. So we took their analysis and we went a little deeper, and we asked ourselves three main questions. Okay. The first question was, well, when we see these global non-US banks, can we establish a link between the cost of funding and financial strains in their home country? So think of Japanese banks.
Right.
So Japanese banks do a lot of dollar business. They face a funding shock in US dollars. Do we see reverberations of this in the Japanese banking system? And the answer to that question was yes, we do see that. So that was the most direct question. The second question was a little more indirect and not as obvious. We said, okay, given that same shock to funding costs, do we see strains in countries that borrow from Japan in dollars, say Thailand, for example?
Kind of, does it spread? Is there contagion?
Does it spread?
Yeah.
Is there a spillover? And we found that indeed, when there are these shocks, they spread to other countries that are twice removed from conditions in the U.S. So that was very, very surprising and very interesting to us as well. So the third question is, if we had stopped there, we would have said, well, there's a problem, what do we do about it? Mm-hmm. So the third question was, is there anything that can help? So the third question has to do with amplifiers and mitigators. So we said, given these shocks that have these negative effects, are there factors in the banking systems, for example, the Japanese banking system, that would amplify these effects or mitigate these effects? Mm-hmm. And some of these have to do with policy. So our main conclusion was yes, we found factors that both amplified, and we found other factors that might mitigate these effects.
Now let me ask you, how surprising is it that banks rely pretty heavily on dollar funding? I mean, you look at the global economy, and the U.S. is almost a quarter of it. You look at the amount of trade in the global economy, and it's even a greater share of it's dollar denominated. So we know that the dollar kind of has this outsized use in global financial markets. Is it really a mismatch that banks use so much dollars in their funding?
That is correct. The importance of the dollar is if you look at it strictly, it's outsized in proportion to the size of the U.S. economy. And a lot has been written on this of the reasons behind the dollar dominance. And we don't go into that in detail, we just take that as a given. We say, given that there's this preference for dollars, and a lot of businesses around the world prefer to be funded in dollars, it's primarily non-US banks that step in and provide this funding. And this is a perfectly effective means of spreading financial resources throughout the world. The problem comes in when these activities, these assets, tend to be longer term, they're loans, and they're being funded on the short term end. So it creates that
duration mismatch.
Exactly.
But one of the things we saw during the financial crisis was that the Federal Reserve was able to step in and provide swap lines. I mean, this is one of the things that may not have gotten the most attention during the financial crisis, but the Fed would make lines available to other central banks of hundreds of billions of dollars, basically taking care of that kind of short-term funding liquidity issue. Is it maybe pretty rational for banks to be in dollars because they have that Fed backstop, or are you a little worried about some moral hazard being created where banks think the Fed will be there for them, even non-US banks think the Fed will be there for them, and so they're taking on too much dollar funding because of it?
Correct. Yes. So one of as I said, the third question we asked was, are there mitigating factors? And one mitigating factor we found was the existence of these swap lines. And we do find that when the swap lines were in effect for different countries, the effects of these shocks into the home country, into the recipient country, were much less. So the swap lines were effective in mitigating these effects. We also found that international reserve holdings by central banks of these countries also had a mitigating role. So what you're asking is about moral hazard, and it's absolutely a legitimate concern, because essentially you think of international reserves and you think of swap lines as being a form of insurance. And every time you have an insurance scheme, there's the issue of moral hazard. So how do you address this? One main tool is supervision. Mm-hmm. So we want to make sure that banks are doing the right thing. They're holding enough liquid assets in dollars.
Right. What can a bank do in this situation? They don't really have a great alternative to the dollar. What are they supposed to do? Just shrink their balance sheets? What is the kind of recommendation for the banking system?
So this effect of shrinking the balance sheet, that's a last-ditch effort, and this is what the spillovers we talked about earlier have to do with it. If banks simply have no alternative funding possible, then they have to shrink their balance sheet, and this has repercussions to their borrowers. But short of that, safeguarding themselves by holding more liquid assets, for example. Or we also found that bank health in general, so having higher capital ratios, higher profitability, better bank performance, makes these shocks less damaging to either the home country or to the third country that receives financing from the global banks.
Well, Adolfo, thank you so much for giving us this overview of the chapter. People can read the full chapter at the IMF's website. There's going to be a whole bunch of interesting research coming out the next week, and so we hope that you're keeping an eye out for it. Thank you so much for joining us here this morning at the IMF.